Put $10,000 on a credit card, pay only the minimum every month, and it can take more than 19 years to pay off, while you hand over more in interest than you ever borrowed in the first place. That's not a worst-case horror story someone made up to scare you. That's the ordinary math sitting quietly at the bottom of your statement, next to the words minimum payment due. Here's the story that number is telling you. Pay this small amount and you're fine. You're current. You're being responsible. It feels like the system giving you a break, a manageable path forward when money is tight and the full balance is an option. By the end of this video, you'll see that number was never actually designed to help you get out of debt. It was designed to keep you paying into it for as long as legally possible. Most issuers calculate your minimum payment as roughly 1 to 3% of your outstanding balance, or a flat dollar amount like $20 or $35, whichever is greater. Federal Consumer Protection Guidance actually uses 2% of the balance as its standard textbook example. 2% sounds almost harmless, barely worth worrying about. But watch what that 2% is quietly buying the bank month after month. The average credit card interest rate in America right now sits above 23%, among the highest of any common consumer loan. On a balance carrying that rate, a huge share of every minimum payment gets consumed by interest before a single dollar ever touches what you actually owe. On some months, on a large enough balance, the minimum barely covers the interest charge at all. The principal doesn't move. Run the real numbers and it gets worse. A $6,000 balance at roughly 24%, paid strictly at the minimum, can take well over 15 years to fully clear. A $10,000 balance at 22% stretches past 19 years. In both cases, the total interest paid over that stretch can exceed the original amount you borrowed. You end up paying for the same purchase twice, sometimes more than twice. Here's the mechanism almost nobody notices while it's happening to them. The minimum payment isn't a fixed dollar figure. It's a shrinking percentage. As your balance slowly drops, the required payment drops right along with it. $50 becomes $48, becomes $45, becomes $42. The payoff curve doesn't just stay slow. It actively gets slower the longer you comply, stretching the finish line further away the closer you think you're getting to it. None of this is an accident of math. It's a design choice built into the business model. Credit card companies earn the overwhelming majority of their interest income from customers who carry a balance month to month. The industry's internal term for them is revolvers. A customer who pays the statement in full every cycle, called a transactor, generates almost nothing for the interest side of the business. The minimum payment exists specifically to keep as many people as possible inside the revolver category for as long as possible. There's a psychological trick layered on top of the math. Behavioral finance researchers have found that simply printing a minimum payment amount on a statement, even one nobody is forcing a customer to actually pay, makes people unconsciously anchor to that low figure and pay less overall than customers who never see any minimum listed at all. The number doesn't just describe one possible payment plan. It quietly suggests the correct one, and most people follow the suggestion without ever questioning it. Regulators did try to push back on part of this. Since 2009, U.S. credit card statements have been legally required to display a minimum payment warning box, showing exactly how many years payoff will take and the total interest cost if you only ever pay the minimum. It sits on the very same page as your bill, printed in plain numbers. Right now, this billing cycle. Most cardholders have genuinely never read it once. So what actually breaks the loop? Pay any fixed dollar amount above the minimum every single month and refuse to let that amount shrink as your balance does. That alone can cut a decade or more off the payoff timeline and save thousands of dollars in interest. Target the highest interest balance first if you're carrying several, a method called the avalanche. Or target the smallest balance first for quick psychological wins, called the snowball. Either one reliably beats minimum payments by years. Zoom out, and the pattern here looks familiar to anyone who's watched this channel before. A number gets framed as a safety net, reasonable, official, printed right there by the same bank that's supposedly on your side. But the incentive sitting underneath that number points in the opposite direction entirely. The minimum payment isn't protection from your debt. It's a subscription to your own debt, billed automatically every month for exactly as long as you're willing to keep paying it. If this opened your eyes, subscribe. Every video, we decode how money actually works. Because the people who understand the system are the ones it works for.